And now, an Envision Financial podcast with Luke Smith on Canberra's 2CC.
That sounds like you. Good afternoon.
It is. How are we going?
Very well. How quickly does Friday come around, right?
We've been saying this for years, and I don't think it's getting any slower.
It was a 4-day week this week because of the public holiday on Monday, the extra public holiday because Anzac Day was on a Saturday, so we had 2 days off on the weekend that were public holidays officially. So you know, if you work those hours, you got two public holidays.
Every cafe owner was in tears, I bet.
Yeah, well, there were words spoken about that issue, that's for sure. But I've always found that when we have a 4-day week after a public holiday Monday, for some reason those 4 days seem to take longer than a 5-day week. I don't know how that works.
Yeah, no, I think I've tried to cram 8 days into 4. It's it's been a long one.
It's always good to be busy.
It is.
And we're rapidly approaching the end of the financial year because today is the 1st of May.
Correct.
May Day. International Labour Day. There you go. Did you like that?
Have another day off.
Well, in Queensland, they'll be doing that on Monday because
there we go.
that's when they have their Labour Day in May because of International Labour Day. Just the rest of Australia decides to do it differently. Here in the ACT and across the border in New South Wales, it's in October. I don't know why or how that's happened, but it just is what it is. Anyway, back to today's topic. We've got the end of the financial year rapidly looming, which a lot of people start thinking about their tax arrangements, don't they?
Exactly.
Now, apparently, one of the ways you can reduce your taxable income is by stuffing some money into your super.
Yes, exactly right. And you've hit the nail on the head. It's becoming more and more prevalent in conversations. Hey, what are we doing? Should I be thinking about? I've just done this. I've just sold that. So today we're just going to sort of lay out at a very high level what people can do and then how they can go about facilitating that, because there's a few different ways to put things into superannuation. And I think that's the key takeout of this first part is understand what's right for you. Just because everybody at work salary sacrifices doesn't mean that you need to. And just because everybody throws the money in at the end of the year doesn't mean it's right for you. Now, I also get all the time, but which one's better from a tax perspective? They are exactly the same. You're not gaining or losing anything in relation to the net tax benefit of putting money into super. And we want to do that because of the premise that my marginal tax rate or the effective tax rate that I pay is more than 15%. And every time we talk about this, people lose their mind over, I'm on 100 grand, I pay 34%. You don't. You pay an effective tax rate up to 100 grand because we get the first 18 for free. Then we get another bit at 19, then we get another bit at 32, another bit at 30, and so on and so on. So you have to look at your effective tax rate. Don't look at, this is the top end of my salary and apply that rate, because that's silly. Okay, and I know people every time we talk about this, people get on YouTube and, you don't know what you're talking about. You've done it wrong, da-da-da. You're always weighing up the tax benefit of the tax that you pay against the tax to put money into super. Now, whether it's salary sacrifice during the year through work, or you get to June and go, okay, my limit's 30,000. I've used 15 because that's come in from my employer. I have 15,000 of space. Now, that is your concessional contribution cap minus what has come in through superannuation guarantee payments under your employment arrangement from all gainful employment. I had a lady in last week. She was adamant, I'm going to do this for that job and this for that job and this for that job. And I said, please don't do that. No. AI told me. All right.
Say no more.
What would I know?
What would AI know?
Exactly. So it's 30,000 from all forms of gainful employment that includes what comes to your employer and what you put in. Now, how do we work it out? I'd be calling my fund in June and I'd be saying, hey, how much has come in? And they will give you, say, up until the end of May. Then you can say to them, what do I get per month? They go, about $1,000. And you go, okay, so I've had this much to May. I know another 1,000's coming in June, and take that figure off your concessional contribution cap. If you're going to go a little bit further with the strategy and say, well, I've got some room in my concessional catch-up space where I've got a balance under $500,000 at 30 June 2025, and I want to consider using this year's space plus maybe the last 2 years where you may have had 10,000 of space in 25 and 10,000 of space in 24. This year I'm going to put in $30,000, provided you have the room in your previous 5 years. Your balance is under $500,000 at 30 June 2025. And that's really important because a lot of people go, oh, well, I'm at 510 now, I can't do it. Well, what was the balance at 30 June? Oh, it was 490,000. Great, you're eligible. So it's eligibility measured at 30 June, not at the time you put the contribution in. So a lot of people get that one wrong. And you can put the money into the superannuation fund. Now, some funds will take an electronic transfer. A lot of funds will take a BPay payment. Now, don't flirt with the end of the year. Okay, BPay is not instantaneous. It can take a few days to clear. So I'd be doing it at the start of June because your fund may close before 30 June. And depending on what day it falls on, if that's a weekend or if it's, say, a Friday or a Monday, if it's a Monday like it has been in a few previous 12-month periods, then you want to be getting things in well before, there we go, it's a Tuesday this year.
Mm-hmm.
Okay, so you make a payment on Friday, it may or may not land by Monday. So we've narrowed that down to what, 26th, 27th is the Friday.
Mm-hmm.
That'd be what I'd be using as a hard deadline so that the money is in the account well before the end of the year, which is the 26th of June. Because if the money hasn't cleared, you've blown up next year and you can't claim it this year. So it's not great. So understand how much you can put in. For people who are self-employed, people that have sold an asset, people that have capital gains tax, you need to say, am I eligible to make a contribution? Now, I also get all the time, well, I'm not working, I can't put money in. Garbage. You can. Under 67, it doesn't matter what you're doing. You might have retired. I had one yesterday. She'd sold some investment properties, made some super contributions with the proceeds, and has to meet the work test because she's 70. She's got to do 40 hours in 30 days to be eligible to make a deductible contribution. And then she can throw the full 30,000 in this year because that will help with the capital gains tax on the sale of the investment properties in this 12-month period. So think about a contribution strategically, not just associated with reducing tax on wages. Think about transactions. You might have sold a whole load of CBA shares this year and sold them out at 180 and went, oh, this is wonderful. And then your accountant says, oh, but you've got to pay this. Oh, so a contribution to super may help negate the tax impact of that. So think about your strategy. I'd be getting in now with accountants. Most proactive people are on the email or the blower to the accountant and say, listen, what am I looking like this year? Especially a lot of self-employed people. How have we gone? What are we looking at? What are my expenses? Oh, you're probably going to have to distribute. Okay, it'd be great for me to. So have those conversations with your accountant because this is where they can add some real value to your situation. If you're in a defined benefit scheme, you need to go to your fund provider and say, hey, what have you recorded against my concessional contribution cap? So that could be CSS, PSS, DFRDB, MSBS, which are the four ones we have here for the majority of the time. They will record what the employer has against your $30,000 limit. For PSS members, as an indication of what you had last year, you can go to page 5 of your 2025 statement, and the second row in the box at the bottom of that page says to you, we have recorded this against your limit. So you take that number away from the annual cap, but remember, that's the 2025 number. You need to log in or call them and say, what's the number for 2026? And then take that figure away from 30,000 so that you're maximising your contributions. And keep in mind, you're going to need another fund to make a personal contribution because they won't take that type of payment. So whilst you may be in a defined benefit, yes, you can make another payment, but you need to remember that it's got to go into a normal accumulation account. They will not take that type of payment. And if you leave it too late, you may need to get a new fund open. So again, be proactive, and that's why we're talking about it at the start of May and not the start of June, because people are getting around to knocking it over.
Now, if you want to, I believe you can put money into your superannuation account beyond that $30,000 limit So long as you're prepared not to take a tax deduction for it.
Correct, that's exactly right. And it's important that we separate your ability to put money in. So you need to think about, why am I putting it in and what am I trying to achieve? I'm trying to lower my assessable tax in this financial year. Great, I can make a concessional contribution. There's our $30,000 limit. I can make a catch-up concessional contribution, and that's looking back 5 years where you haven't used limits in previous years. And as I said before, your balance is under $500,000 at 30 June 2025. If you've just sold an investment property, you're thinking about retiring in July and you want to get big chunks of money in, you can put $120,000 in as the annual non-concessional limit, so no deduction is claimed. Or you could put in $360,000 if you haven't put any in the previous 3 years. Or you could do $120,000 before June and $390,000 on the 1st of July, because the annual limit of $120,000 is going to increase to $130,000. And the current $30,000 limit for deductible contributions is going to increase to $32,500. So you'll have a little bit more room next year to get a little bit extra in to lower your tax. So it's important we understand, am I eligible? What am I doing? What am I trying to achieve? And then where does it go? And it's really important that you put the money in first, and then you lodge what's called a notice of intent, where you are using your own funds. And I cannot stress enough, do not get this wrong, because no form equals no deduction.
And that's not what we want.
That is not the point of the exercise.
Indeed.
So be aware.
Luke Smith from Envision Financial is with me in the studio today, and we're working out how you can get some money into your super this year to lower your taxable income. How much can you put in? How do you go about doing it? So, Luke, what are the key things for people to remember when attempting this strategy?
I think we need to keep in mind that understand your limits, understand what you're trying to achieve. And in this example, we're talking about maximising deductions. So if you can get up to the $30,000 cap, check. Don't assume. Get your paperwork right. Now, if you salary sacrifice, you don't need a notice of intent because your employer is claiming the deduction.
Yep.
If you are using your own money, you need to get that money in and cleared before 30 June. You need to then lodge a notice of intent to where you put the money. That one seems to confuse a lot of people. Do I send it to the ATO? Do I give it to my accountant? You put in your money. You send a form that says, hey, I put 10 in, I'm claiming 10. You sign it, you send it to your fund. You need that because without that form, all super funds will assume that it's a tax-free payment unless you notify them, hence the name. Standard ATO form, quick Google, you'll find it in 0.3 of a second. Fill it out, send it in. The fund will write back to you and say, hey, Leon, thanks for that. We'll process that correctly for you. Keep that communication. Your accountant may ask you for it, and it's good proof that it's been processed correctly. So get your paperwork right, get it in nice and early. Check with your fund if their closure date is before 30 June. And as we said before the ad break, with it being the Tuesday, you'd want to have money in and cleared by Friday the 26th as a best practice measure, but check with your fund. Don't be making a payment on Monday night.
No.
By BPay.
No, indeed not. And, of course, even give yourself a week or so to be on the safe side.
Look, I say 1st of June, don't dance with the devil. If you're going to use the catch-up concessional legislation, look and see how much room you have. You can do that by contacting your fund and asking what your concessional contributions have been in previous years. You can also log into MyGov as a guide. I wouldn't trust it wholly and solely because the super funds can report late and they can get it wrong. So I'd get it from MyGov, then I'd check with the fund, make sure the two numbers match. And then think outside the box in relation to what would I benefit from if I did this. Remember, you don't have to be working to make a contribution under the age of 67. You can make a contribution over the age of 67, provided you meet the work test, which is 40 hours in 30 days. So there's lots of opportunity there to be able to get the money in, but we always have to come back and say, Why am I doing it? What am I trying to achieve? And if you're in a defined benefit scheme, remember you're going to need somewhere else to put it. So you may need to open up a new fund well in advance of June so that you can have somewhere to make the contribution in conjunction with what your defined benefit has recorded against your cap.
Alrighty, so we've just about reached the end of the wagon here, but I think the most important thing to repeat one more time is don't forget the paperwork.
Listen, the devil's in the detail. And yeah, it's also, don't send, I had this one the other week, don't send the form in before the money.
Ah, yes.
So someone did that, and then the fund wrote back and said, no, Leon, you can't have a deduction. And then she rang me up and she said, you told me I could get a deduction. You told me the money. You told me. I said, oh, okay. When did you put the money in? Oh. So money first, form second, keep the notification back from the fund, keep a copy of the notice of intent, give it all to your trusted accountant. They will thank you for your accuracy.
Fantastic. So it's time to ask where can listeners get more information?
Yeah, so 6260-4749. We've got envisionfinancial.com.au on the internet. We've got the Strategy Stacker, Luke Talks Money on iTunes and Spotify. We've got Envision Financial Canberra on YouTube, where we've got all of the back catalogue of stuff, so you can find a show on concessional, non-concessional, catch-up concessional, whatever you want to bang into super. We don't have one on banging it into super, but you know what I mean. And we've got Smart Money Strategy, my ultimate guide to financial planning in all good and bad bookstores and online.
We'll catch you again next week.
See you then.
Luke Smith from Envision Financial back again at the same time next Friday.